Chapter 7, Bonds and Interest Rates. In this chapter, we are again continuing what we were doing in chapters 5 and 6. The last part of chapter 6 was on different types of loans. In chapter 7, we will continue looking at loans. Let me start with a big picture of what chapter 7 and then chapter 8 will be on. Chapter 7 is on a real-life example of an annuity. So we will see how the annuity calculations fit into a specific type of loans called bonds. Bonds are loans that large corporations have in order to raise money for their projects. And then in chapter 8 that will follow, we will look at a real-life example of a perpetuity where our perpetuity calculations can be used. And that's the topic of stocks or stock shares. Bonds are financial securities sold by companies or governments to borrow money from the public on a long-term basis. So think about how you can borrow money to buy a car, right? You can, go to your bank and ask for a loan for, let's say, $20,000. Or maybe at the car dealership, they have a financial services department which can also offer you a loan, right? Well, imagine now a large corporation. A large corporation may want to borrow $1 billion, right? Maybe it would like to acquire its competitor. Do you think a large corporation that needs $1 billion can walk into a local bank and ask for that kind of money? It's probably not going to happen, right? Because it's a lot of money. And so imagine if there was a way for that large corporation that needs $1 billion for some major project. Imagine if it was possible for it to borrow a little bit from you, a little bit from me, a little bit from a whole bunch of people in this country, or more, maybe even in other countries. And then all those small loans would add up to a total of $1 billion, right? So this is exactly how large corporations can borrow money in this world. They sell a whole bunch of bonds. Each bond is sold for some amount of money, relatively small, let's say around $1,000 plus minus. And by selling a lot of such bonds, the company is able to borrow the large amount of money that it needs. It could also be a government, like local California government or federal government, that needs to borrow money. This can also be done by issuing bonds. So bonds is like a long-term loan. So let's say a company that sells a bond is essentially borrowing money from whoever bought the bond from the company, and in return the company will be paying it off with the interest on top, like with any loan, over, let's say, 10 years, maybe 20 years. It could be shorter than that, but generally it's a long-term commitment for the company. Bonds are also known as debt securities because they represent a company's debt. A company owes money to those investors who bought its bonds. And it will be making payments back that will also reflect interest for up to 30 years since the issue. So the seller of bonds, which could be a company, it could be government, is also known as a debtor or a borrower. And those investors or maybe other companies or other governments that buy these bonds, they are lending money, right, to the issuer. So they're called lenders or creditors. This is an example of America's debt. So it's a little bit old. It goes back to May 2016. A figure I found on CNN.com. Who owns America's debt? So this is federal debt that the federal government issued as bonds, and these bonds were sold to whoever would like to purchase them, and the buyers came from all over the world. So who owns America's debt for that time, which is $12.9 trillion? China is the number one lender, 1.3 trillion. Then goes Japan, 1.1 trillion, and then a whole bunch of other countries. And there are other, investors inside the United States which make up the rest of this large $12.9 trillion amount. So this is kind of to give you an idea of who may be, the people or, the agencies, the institutions who buy bonds issued by, let's say, a government. Although in this chapter will be primarily, all our examples will be about corporations rather than governments. So let's say a company or a government borrows money from the public by selling bonds, right? And so the price at which each bond is sold at is exactly how much was borrowed by that company or government with each bond sale. And in return, kind of like with interest-only loans that were covered in the previous chapter, the corporations or the government will be paying back regular loan payments that reflect interest. It's actually more like interest-only loans. So the company or the government will be paying interest periodically, and at the very end, it will also pay the borrowed amount in one large chunk. Bonds have their own terminology. Face value or par value or simply par. Coupon rate, coupon payment or simply coupon. Maturity date or time to maturity. And yield to maturity or simply yield. So let's discover on the next slide what these terms refer to. The payments that pretty much reflect the interest payments on the borrowed amount of money are known as coupons or coupon payments. When the last coupon is made, at the same time, the borrower will also pay, the borrowed amount of money, which is known as the face value. It's actually may or may not be exactly equal to how much is borrowed at time zero. We will see that in the next examples. The time between today and when the last payment will be made is known as the time to maturity, abbreviated as TTM. Face value can also be called the principal value or the par value or simply par. And in most of our examples, we will be using $1,000. So even if it's not given, you should always assume that the face value is equal to $1,000. And this is true for most corporations and government bonds. Some government bonds have a much larger face value, but unless specified, you should assume $1,000. Next, how are coupon amounts calculated? There is always one extra information that is given, known as the coupon rate, some percentage, let's say 5%. You take that percentage, the coupon rate, and multiply it by the face value, which, as was just explained, is usually $1,000, right? So let's say the coupon rate is 5%. You multiply it by $1,000, you get $50. So that's the coupon that will be paid at the end of the first year, at the end of the second year, third year, and fourth year. Every year, the same dollar amount. And one more thing that is typically given for bonds. That's the discount rate, or IY in the financial calculator. When we talk about bonds, we call that yield to maturity, abbreviated as YTM, or simply yield. So this is also something I found on Morningstar.com. It's also a little bit old, about a year or so old. It shows the capital structure of Starbucks for that time. The orange area reflects what is known as equity, and the dark blue area reflects the amount of debt. So this figure shows that in March 2017, the proportion of debt, how much money Starbucks owes to others, is a little over 41% of total money that it has on its hands. And the historical proportions of debt to equity are similar to that. Now let's look at a little bit more detail on, debt, what exactly it looks like for Starbucks. So at that time, March 2017, this is the kind of bonds that Starbucks had. And notice that I didn't say bond, it's bonds. And by plural, I don't mean that there are many bonds. There are actually many different types of bonds, and each type has many bonds, right? Like the count. For example, we see 1, 2, 3, 4, 5, 6, 7 rows in this little table. These are different types of bonds. For example, the percentage here, 3.85%, is the coupon rate, right? It's also repeated in the coupon percentage column, 3.85%. The second row shows 2.1% coupon rate, right? So you would take this percentage and multiply by $1,000 face value. That would give you the coupon amount paid every year. Then maturity date, another column. For example, the first type of bonds matures on October 1st, 2023. This means that this is when the very last payment will be made by Starbucks to the bondholders. In the second row, the maturity date is February 4th, 2021. Again, that's when the last payment would be made. Then we also see different amounts in millions of dollars, right? So there were different amounts of money borrowed at different points of time. And in the maturity date column, we see when the last payment would be made for each group of bonds. And so on. So there are, different characteristics of these 1, 2, 3, 4, 5, 6, 7 different groups of bonds that Starbucks owns. And in the last column, you can also see how the yield to maturity, which is the discount rate, or IY, differs for all these different categories. For example, you may notice that the yield to maturity is by far the highest, 3.99%, for the bonds which have a very long time left until they mature, which is the year 2045. And this is probably because there is so much uncertainty about what will happen in the economy between now and the year 2045 that whoever buys such bonds, they commit to basically a lot of uncertainty between now and the year 2045. And because of so much uncertainty, or in other words, risk, those bond buyers require a compensation which comes in the form of a higher return on their money, which is essentially the yield to maturity on such bonds. So there are like a lot of stories that could be told when we compare different groups of bonds. So now let's look at like a different side of bonds. So let's say today there is a company that sells bonds. So again, let's continue talking about Starbucks. So Starbucks decided to sell bonds. Why? Because it needs to borrow money for something that's important for its business. Let's say it sells bonds to Mr. Connery. Then Mr. Connery, he bought these bonds. Maybe they have 20 years to maturity, but he's actually not obligated to hold these bonds for such a long time. He's free to sell these bonds at any time he likes. And let's say at some point he sells his bonds and their new buyer is Mr. Brosnan. And then Mr. Brosnan again can sell his bonds at any time he likes. And let's say they end up in Mr. Craig's hands, and so on. So bonds switch hands. The ownership changes, all the time. Have you noticed the strange last names? Well, remember James Bond? Hint, hint, bonds. That's what this chapter is about, right? Okay, so back to financial securities, right? So what am I trying to say with this, sort of timeline? What I'm trying to say is that bonds can be resold. Somebody sells them, another investor buys them, right? One thing remains: when these bonds mature, when the last payment would be made by Starbucks to the bondholder. Another thing that remains constant throughout the years is the coupon rate, let's say 5%, that determines the coupon payment every year, as well as the face value, which is the additional dollar amount that will be paid at maturity on the very last date. But one thing that will be changing throughout these years is the price on the bond, right? So maybe Mr. Connery sold the bond for $900, but Mr. Brosnan then sell these bonds for $1,200 to Mr. Craig. So the price fluctuates. Okay, so now let's look at the price. What determines the price on a bond? Well, the price should reflect how much a bond is worth, or the bond value. And each bond should be worth no more than how much money it brings you in the future, right? So you would never want to pay more than what you're expecting to get from it, from the company that issued the bonds. So what is the bond value? How much should each bond sell for? How much money does the firm raise or borrow with each bond? These three questions ask you to calculate the same exact thing, right? So we usually call it bond value, calculating bond value, or bond valuation. And like was shown earlier, what you get in the future when you buy a bond is annual coupon payments, as well as the face value at the very end. And you will continue receiving those coupon payments until maturity. So you look at the amount of time that's left, and then that becomes part of our calculations. So what are the calculations that we need to do? Well, the coupons are constant. They will be repeated every year, and they will eventually end. This is the definition of an ordinary annuity. So we have that as part of the cash flows from a bond. And we also have the face value at the very end, like a single cash flow, right? Sort of by itself. So to find how much you would be willing to pay, or the maximum you would be willing to pay for a bond today, if you are on the investor side, on the buyer side. And if you're on the firm side that's selling the bond, the question could be rephrased as how much the firm should sell each bond for. So that becomes nothing but the present value of all the coupons, the annuity of coupons, plus the present value of the face value at bond's maturity. So we just add up the two sort of components of the bond value. And so the bond value is equal to the sum of the present value of an annuity of coupons and the present value of the face value at maturity. And the formulas are from, the annuity formula from chapter 6 for the coupon part, and for the face value part, it's kind of going back to chapter 5. discounting a single cash flow back to time zero. Okay, let's do our first numerical example on bond valuation. GoldenEye Company, that's one of the James Bond movies, right? Issued bonds with a coupon rate of 10% and annual coupons. The par value is $1,000 and the bonds have 5 years to maturity. The yield to maturity on similar debt issued by similar companies is 11%. What is the value of each bond? This question could be put in different words. How much money can the company raise with each bond? Or how much should the company's bonds sell for in the market? It's all one and the same thing. So 10% coupon rate determines the coupon amount every year. The face value is given as $1,000, which is the same thing as the par value. This could be completely omitted, in which case you would assume that the face value or the par value is $1,000. And another important thing that I haven't mentioned yet is what's important for bond valuation is how many years are left until maturity. For example, maybe these bonds were sold originally 7 years ago, right? Which means 7 years until now plus another 5 years from now until maturity makes it originally 12-year bonds. But we don't use 12 years for our bond value calculations, but we only use how many years remain until maturity. That's important. So always make sure you're using the number of years between today and the maturity date, the remaining time until maturity. Okay, so the coupon amount is always calculated the same way. You take the coupon rate and you multiply it by the face value. Both are given 0.1 coupon rate multiplied by $1,000 face value. That gives the annual coupon amount of $100. And we have now everything we need to compute the bond value. We can either plug in the numbers into the formula or use the financial calculator. So let's see how that's done. If you use the formula, then you will get $963.04. And now the formula. The formula is, now the financial calculator. The financial calculator uses the same keys as an annuity. You enter the coupon amount, $100 is the PMT, and so on. But one extra thing that needs to be entered now is the $1,000 future value. Okay, so let me bring up the financial calculator and explain how we solve this kind of problem. This is the financial calculator. Turn it on. It's always a good idea to clear everything, even if you used your calculator a few days ago. Second, plus minus, enter, does a full reset. Now we are ready to go. Maybe we also want to increase the decimal places. Let's do that. Second decimal place, let's make it not 2, but maybe 6. I press 6, enter, it's done. And if I turn the calculator off and turn it back on, it's keeping 6 decimal places. Okay, now let's begin. Again, in no particular order, as always, you enter the information that is given. And now there are 4 numbers that need to be entered. With annuities, in chapter 6, it used to be 3 numbers, N, IY, and PMT. Now there is an extra number that needs to go into the calculator, the face value or the future value, $1,000. So our coupon payments will be $100 each every year. You put 100, as usual we make it negative and save as PMT. Then not only will we be receiving $100 coupon payments if you buy such bond, but we are also going to receive $1,000 at the very end. So let's enter that as our next piece of information, 1,000. And because it's just like coupons received by the bondholder, you use exactly the same sign. So we made PMT negative. You're also gonna make your future value negative. So you press the plus minus key and then you press FV. So FV stands for future value, but here it's also the face value when we talk about bonds. And then in no particular order, you enter the discount rate, 11%, which is also known as the yield to maturity when we talk about bonds. So I press 11 IY and 5 for N. 5 is how many coupons there will be between now and the maturity date. So 5N. And we want to compute the present value of this bond. $963 and a little bit more than 4 cents, right? So the new thing here is entering the face value, which is FV, future value. And it's always $1,000. And the important thing is, like I explained on the slide, both the PMT, the coupon amount, and the FV, the face value, must be entered with the same sign. So I showed how you enter both as negative. What if you didn't? What if you left them as positive? The only thing that would be different is that when you get your bond value, the answer, right, on the display, it would be displayed with a negative sign. Otherwise, it would be still the same dollar amount, $963.04. So let's continue. In chapters 5 and 6, we saw that whenever the interest rate or IY is higher, the present value is lower, right? So there was this negative relationship between the discount rate or the interest rate and the present value. And it remains true when we talk about bonds, right? Why would it be any different? It's the same. So IY, the interest rate, is called yield to maturity, and the present value in the context of bonds is the bond value, what we just did. So there is again a negative relationship between the yield to maturity and the bond value. So let's actually, kind of prove it. What we just did was an example with the yield to maturity, the interest rate, right, of 11%. We had 5 years to maturity, $1,000 face value on the bonds, 10% coupon rate. And the present value that we found earlier was $963.04. What if we lower the yield to maturity, the interest rate, from 11% to 10%? The negative relationship tells us that that should make the bond value higher. And if we repeated the financial calculator keys and only changed the IY from 11 to 10, we would get the higher bond value, and that would be $1,000. If you make the yield to maturity, the IY in the financial calculator, even lower, then the bond present value will become even higher because of the negative relationship between the two. And if we redid the calculations in the financial calculator, we would get the following answer, $1,079.85. That's the bond value at 8% yield to maturity, right? So as we lower the yield to maturity, we increase the bond value. So that's a negative relationship, just like what we saw in chapters 5 and 6 with a single cash flow or with multiple cash flows. Now notice how in the second example on the slide with the 10% yield to maturity, the bond value became exactly $1,000. Is it a coincidence? No. Turns out that whenever the coupon rate and the yield to maturity are identical, right? In our example, they are both 10%. You will always get the bond value of $1,000. You will always have $1,000. Even if the coupon rate is, let's say, 15% and the yield to maturity is 15%. As long as they are the same, you will always be getting $1,000. So if you know this trick, if you're given the same percentages for the coupon rate and the yield to maturity, don't even spend your time calculating the bond value. $1,000 is your answer. We also say that the bonds that sell at $1,000, which is their face value or par value, these bonds sell at par. If they sell for less than their par value, then they are known as discount bonds, right? So $963.04 is a discount bond. So it's like if you're an investor and you're buying such bond, which was issued by some company, you're kind of buying it at a discount, because when in the future you'll be receiving your interest payments, known as coupons, and then the last lump sum payment at the very end, which is $1,000, it's kind of like, you're lending less than what you're getting back. So you're lending $963, but you're getting back $1,000 in future value, in face value, together with all the interest until then. If instead the bond present value is above $1,000, like in the last case with the 8% yield to maturity, right? $1,079.85. That kind of bond is called a premium bond. And just to repeat again, whenever the yield to maturity or IY, right, like the discount rate, is above the coupon rate, you're always going to get the bond value below $1,000. That's a discount bond. If the yield to maturity and the coupon rate are the same percentage, you will always be getting $1,000. These bonds are said to sell at par. And premium bonds are the ones that are worth more than $1,000, and that's always going to happen when the yield to maturity is less than the coupon rate. So this is like, a little rule that you could always keep in mind when you do the calculations. So why does it even let's make a step back. What we just did was calculating the bond price or bond value for different discount rates. Why did we actually have to do all that? And that's because in the real world, interest rates are always fluctuating. We are going to cover this towards the end of this chapter. Why? There are different things that are happening that get reflected in interest rates on bonds. So at this point, let's just, take it as given. Interest rates fluctuate over time. And because they do, bond value will also constantly fluctuate over time. And what this in turn implies is that if you bought a bond yesterday and paid some amount of money for it, then maybe if the interest rate went up overnight, then your bond value went down overnight. So what you paid a lot of money for yesterday is not worth as much money today. So as an investor, because of these constant fluctuations in interest rates on bonds, you're facing this risk of your bond value going down unexpectedly. Technically in finance, we would use the word risk when the price unexpectedly goes up. So any sort of fluctuations are referred to as risk in finance. And we call it interest rate risk. So people who buy bonds issued by corporations or governments, they face this so-called interest rate risk. So it's the fact that the value of the bonds on their hands will be fluctuating whenever interest rates change. Turns out that when you buy bonds, right? So now you're a bond holder, you own bonds. And so it turns out that your bond value will be going up and down, right? So fluctuate significantly more if the bonds that you hold have a longer time to maturity, or if they have a lower coupon rate. So let's see what's the intuition behind these, two factors that affect the interest rate sensitivity of bond value. Let's consider this figure. This is figure 7.2 in our textbook. On the horizontal axis, we have the interest rate. That's the yield to maturity, the IY in the financial calculator. On the vertical axis, we have bond value in dollars. Then we know that the relationship between the interest rate and the bond present value is negative, right? We just had it on one of the earlier slides. And that's why we see the lines sloping down and to the right. Now, why are there two lines? Why not one? Because we are comparing two bonds. The green line is a downward sloping line for a bond that has 30 years left to maturity. It's a 30-year bond. The blue line, which is a lot less steep, is for a different bond, which has only 1 year left to maturity. So it's kind of, a very long-term bond and a very short-term bond. What do we see going on here? Imagine you changed your interest rate, the yield to maturity, the IY in the financial calculator. So you change it, let's say, from 5%, increase it to 10%, then increase it to 15%, then increase it to 20%, and recalculate the bond value for each of the two bonds. When you do that, so you will be getting new numbers for the bond values, right? If you plot the results on this figure, you would get these two lines, the blue line and the green line. The blue line for the 1-year bond, which is almost flat, and the green line for the 30-year bond, which is a lot steeper. Right? So it kind of comes from the calculations that you can actually, try doing yourself. It could be a good practice. And so bottom line, the steeper line for the 30-year bond, the bond with more time left to maturity, has a much higher interest rate sensitivity. So the bond value is very sensitive to changes in the interest rates, in the yield to maturity, right? Whereas the 1-year bond with a flatter line has little fluctuations in bond value when the interest rate is changed, right? There's almost no effect on the bond value. It's always around $1,000 on this figure, even if we double or triple the interest rate. So make it from not 5% but 10% or 15%, right? The bond value is still very close to $1,000. So very small drop in bond value. So that's the interest rate sensitivity depending on how much time is left until maturity. That's what this figure summarizes. And the intuition, so I just said that you can verify that this is what will be happening. If you try changing the interest rate and recalculate the bond value and see how big the changes are. But there's also a different kind of an intuitive explanation for why this is happening. So consider a longer time to maturity bond. If it's, let's say, a 20-year bond or a 30-year bond, which will see coupons being paid over 20 or 30 years, right? Then the $1,000 face value is at the very, very end of this long time period, right? And the $1,000 face value is by far the largest cash flow on our timeline because the coupon payments are significantly smaller. So those would be maybe $50 a year, maybe $100 a year. And because the largest dollar amount, the largest cash flow, the $1,000 face value, is at the very end when we discount it as, part of finding the bond value, we end up discounting it very heavily. And so any slight change in the interest rate will dramatically affect the present value of the face value of the bond. So if the interest rate goes up, the present value will go down by a lot. And so because it's a huge portion of the sum of all cash flows on the bonds timeline, we end up observing a higher sensitivity of bond value to changes in the interest rates. Turns out there is another factor that plays a role. We get exactly the same higher sensitivity of bond value to interest rate changes if we have a bond with a lower coupon rate. And actually, the interpretation is, the intuition is exactly the same as earlier with longer term bonds. So think about what a lower coupon rate bond really means. If the coupon rate is low, right, some small percentage, like 3%, 2%, then relatively to the coupon payments, the $1,000 face value will seem like a huge number, right? So the face value is a much higher fraction of all bond payments on the bond payment timeline. And then the rest of the intuition is just like on the previous slides where we looked at the effect of the time to maturity. So because the face value is at the very end, it's discounted very heavily. And so since it's a huge fraction of all bond payments between now and maturity, any slight change in the interest rate dramatically affects the face value, the present value of the face value, which in turn plays a huge role in determining the bond value, right? And so a bond with a lower coupon rate will fluctuate in its value a lot more when interest rate changes. So we observe a higher sensitivity of bond value to changes in the interest rate. Next, this topic is called current yield. What is a current yield on a bond? Think of it as a 1-year return on your money when you buy a bond that some company or government issued. So a 1-year return is what you get back in 1 year divided by what you paid for that, financial security today. So you take, to calculate the current yield, you take the coupon payment, which is the money you will get between now and end of the first year, and you divide it by the price of the bond that you paid today. So this becomes the first year return on your money. So let's say the coupon payment is $100, right? And the price is $900. You take 100, you divide by 900, and you get something around 11 and something percent. So that's your first year return on your money. It's not, current yield sounds a lot like just yield, which is another term for yield to maturity, but it's not the same thing as yield to maturity. In our previous examples, with the coupon rate of 10% that determines the coupon amount, $100. And then we varied the interest rate, the yield to maturity, from 11% to 10% and then to 8%, right? And we got 3 corresponding bond values. So to calculate the current yield in those 3 similar scenarios, where the only difference was the interest rate, the yield to maturity, we take the $100 annual coupon payment and divide it by separately by each of these 3 prices. And we get the current yield of 10.38%, 10%, and 9.26%. In this country, bonds usually pay coupons semi-annually, so 2 coupons every year, one after the first 6 months and the second one after the second 6 months. Let's do an example. Let's say we have Quantum of Solace Corporation, another one of James Bond's movies, is raising money for new investments by issuing corporate bonds. The bonds have the following characteristics: 10 years to maturity, 8% yield to maturity, 12% coupon rate, and coupons are paid semi-annually. Same question as in the previous problems. How much can this corporation raise with each bond? In other words, we are asked to calculate the bond value. We have a 12% coupon rate, so as always we can multiply it by a $1,000 face value, which will give us $120 in annual coupon. Except because our coupons are now semi-annual, we get half of that every half a year. So every half a year, whoever buys such bond will receive a $60 coupon. We have 10 years left to maturity, which means there will be a total of 10 times 2 or 20 coupons paid between now and the maturity date. And this is what we will use for N in the financial calculator, because remember, in the financial calculator, N refers to how many recurrent payments we will have. Our recurrent payment is $60 repeated over and over every half a year. And we need to use N that reflects how many of those we are going to have. And to be consistent, everything throughout our calculations of the bond value should reflect this semi-annual frequency. So for the IY, the interest rate, the yield to maturity, we need to use this semi-annual interest rate. If per year it's 8%, which is given, then we need to divide it by 2. And 4% is the correct discount rate that we will use. So plugging these numbers into the bond present value formula will give us the bond value of $1,271.80. This is a premium bond because it costs more than $1,000. And of course, you can do it in the financial calculator. So let's do it together. Let's clear everything we had from our earlier calculations. Let's also increase the decimal places. Let's try second decimal place. Let's make it 6. Enter. Let's begin. So in no particular order, we need to enter the future value or the $1,000 face value, PMT, the dollar amount of each coupon payment, the number of coupon payments, N, and the discount rate or the yield to maturity, IY. So let's start with the face value. 1,000, we are making it negative, right? Press the plus minus button and save it as FV. The same sign should be used for the coupon payment. What is our coupon payment? Every half a year, it's $60. So you put 60, you change the sign to negative by pressing the plus minus key, and then you save it as your PMT. Then, how many of those recurring coupons will there be? A total of 20 coupons. You use that for N. 20 N. And the fourth number that is entered is the discount rate. It should also reflect the same semi-annual frequency, 4% yield to maturity per half a year. So I put 4 IY, and I'm computing present value, $1,271 and about 80.5 cents. So technically, if it's rounded to 2 decimal places, then that would be 81. If it's rounded to 1 decimal place, like on my slide, it's just 0.8 at the end of the answer. So keep consistency. If you have semi-annual coupons, you need to adjust kind of 3 things. The coupon is the annual coupon divided by 2. The number of coupons, number of years left to maturity multiplied by 2. And the discount rate, it's the annual yield to maturity divided by 2. These 3 things, all 3 must be made in order to do the calculations correctly.